Hi, Chris. Are you unmuted? Oh, there you are. Okay, let me unmute you.
Can you
Welcome
hear
back to
me?
F.A.C.E, Chris. Welcome back, buddy.
Hi, yes, good to be here.
Yeah, good to be anywhere nowadays. So I'd like to open it up with this question. Are you finding the markets a little more challenging in this pandemic than the last one?
Uh, um,
Oh, you're not as old as me, Chris. Okay, so
actually, my father, who was born in 1909, had the 1918 flu, and
wow.
he remembered the quarantine, and he used to tell the story about being quarantined, and then, just like today, everybody needed a haircut when it was lifted, and his
Right.
father took him to the barber shop in Boston. And there were always two chairs there, but when they went, there was now only one barber. And
Oh, yeah.
my father
Yeah.
went into medicine, and so he became, he was very interested he used to say that, well, we're going to have another, uh, another epidemic,
100
another
years.
pandemic will come.
Yeah, did the anything the spiral calendar uh, point towards this type of historical event?
Well, not this event, but how what I really want to talk about today is the long
Okay,
term picture.
right.
And obviously the pandemic is part of it, but I think even more so, the government actions and the Federal Reserve.
Yeah,
And a question that's been boiling in my head for a couple of years is how the Federal Reserve actions and their interventions and money printing and all, how does that change long-term cycles? And can the Fed defeat cycles, or do they only postpone them? Uh,
yeah.
that's and
It's a big
and if you
debate.
believe that there are some fixed cycles at work, then that becomes a more interesting question. If you don't believe in fixed cycles, then you can just think, well, the Fed is just going to blow things up and then destroy them and whatever. But I've always been interested in, well, what happens to these cycles after all this activity by governments intervening in free markets. So that's kind of the theme here today. I put together some slides,
Okay,
um,
I'm
and we
interested.
can go with that.
So should we? What season are we in here, Chris?
Well, that's
Winter.
that's the thing, because we should have been in winter a long time ago. But the Fed kept pumping in all this money. They, in a sense, prevented what should have been a natural collapse to occur either after the 2000 top or after in 2009. But they just kept
Right.
flushing things in. So,
And
this is
again
sort of
now,
the
right?
classic. The first slide is the classic long wave model
Right.
of prices rising and falling, and then equities doing two cycles within that cycle. Um, and here is it playing out across the data, mostly in the 20th century. And you have these really healthy stock markets during spring and fall, but summer there's too much inflation for stocks, and in winter there's too much deflation for stocks. Uh, but what I noticed when looking into the long wave was that there was this um, double tops and double bottoms that are very regular, almost 7 or 8 year separations between them. Um, and my investigation led me to eclipse cycles as really the driver of the long wave. And we
Oh,
have lots of eclipses. There's every 6 months there's another
right.
set, but not all eclipses
Lunar or
are.
solar, Chris?
Pardon me.
Lunar or solar, which
Well,
has
I'm
more
really, in
significance?
terms of market tops and panics, I'm looking at solar, but
Okay.
both. What's interesting is, not all eclipses are equal, and I had a discussion. This work kind of came out of uh, discussions back and forth with Arch Crawford about 22 years ago. And, he would say, okay, the certain eclipse is important because planet Y is doing whatever. And I'm like, no, planet Y has nothing to do with things. But it turns out that the eclipses where everything lines up more centrally, in other words, how close is that alignment between Earth, Moon, and Sun? Those central eclipses are the ones that are important. So, I mean, this is a chart goes way back to 2002. And so, looking for this pattern of double tops and double bottoms to repeat, and then, asking what happens with the Fed action. Well, now in spiral calendar terms, the 27th spiral calendar time unit is 35.8 years. And that is very close to 2 times the eclipse Saros cycle, which is 36 years. So the first clue for me that the Fed can't get rid of cycles is when gold bottomed within 12 days of that anniversary of the 1980 peak, and that gold low in December of 2015 to me is extremely important because it says that there. I guess I have a dispute with deflation. I mean, there's deflation going on now, but in some terms, we've already passed the deflation cycle. The fact that gold bottomed in 2015 says that
Right.
that was over. And, but, the Fed actions have prolonged things, they've postponed things, that we failed to clear markets of debt, et cetera, et cetera.
Yeah, not many would view this chart in current conditions and say that there's potential that this last rally from the D's 2015 low could end up being a failing rally, Chris, and we get one more whiff of
That's where I
deflation.
think definitely not, because of the timing. And, so it's interesting. I know there's a fellow on Twitter, I think you've had him on, Henrik, and
Yes.
I went head to head with him a year or two ago and he correctly was like looking for deflationary collapses like we've had in crude oil. But,
Right.
we've watched crude oil go from 80 to minus 30, but the metals markets haven't cracked. And so
Not at all. Yeah.
and what I think is going on is the metals markets are looking ahead.
At yields.
Now this chart really is both gold and the 10-year yield. The yield is inverted.
Okay.
And that same 35.8 year cycle. So this was, I did some long-term videos for subscribers back in January. This slide is from that. And, we would have expected, without the Fed acting, you would have expected rates to bottom a few years ago, but they didn't. And so
Right.
I was looking at the spiral calendar anniversary of the second rate peak in 1984 as marking the end of the bond bull market. So in January, I was really called for the bond bull market to end around the 30th of March, plus or minus a couple of weeks. And
Great call.
yeah, and
180.
The actual top was the 9th of March, and now it's a wounded. I mean, bonds are kind of over. It's a wounded market. The Fed's going to support it, but they've got so much paper to issue. Where's the confidence? I don't think this ever comes back. So
yeah, I'm in that camp, Chris. Do you think they've taken the markets away from us? And I was thinking about this, like, they're going into junk and corporates, and maybe they're doing that at the expense of sovereigns, because the sovereigns.
Of course. I mean, it's right. I was looking for a top in the bond market, and what we got instead was they blew it up. I mean, they just detonated it, and it doesn't mean anything, right? I mean, what's sovereign money mean anymore when they're printing whatever they want or buying whatever they want? It's all kind of crazy.
Your previous slide says that we have the one before the one more back, because I just want our viewers and have you on record that we have something major coming up around the solstice.
Well, yeah,
the eclipse.
This is the second part of the discussion today.
Okay, go ahead. Okay, I threw you off.
Yeah, and
we'll come back to it.
It's good. We needed to go back to this slide.
Okay.
The 1984 peak in rates, the second, the high in rates was 81, and then it made a lower high in 1984. and that occurred on the exact day of this eclipse, Saros cycle 137. I mean, literally, the eclipse shadow was crossing Manhattan Island when bonds bottomed and rates peaked. And so that same, 36 years, that eclipse is due in June. Now, what's really interesting is this eclipse falls right on the solstice. I mean, it's literally 9 hours apart, I think, from the perfect solstice moment.
That's why I noticed it.
Maximum
Yeah.
eclipse.
Yeah.
But
I'm an amateur planetary guy.
yeah, but that eclipse cycle 137, that was also the recovery high in 1930. Yeah, and you remember we had we don't remember, we weren't around, but the crash in 29, and then there was this relentless rally, and it went further than everybody thought. And it I think it topped about 11 days before that eclipse in April of 30.
Interesting.
So now I think we're in this similar situation, and I mean, to me, the cycles, they're the emotional component. They're the thing that people can't put their finger on. When people say, "Gee, why the heck is the S&P going up when the world is ending?" Well, it's because we're still in this very strong emotional cycle. And I think once we get into June, somewhere around June, this thing's going to roll over and then it's dead. Here's another chart from looking at that long wave seasonal model, and this was the rate low. Here the question marks we filled in. Now we've got that in 2020. The gold one was in place, and the central banks, again, they were just pumping in crazy money and preventing the stock deflationary collapse. And so what I think that the result of the central bank actions ultimately is that we just jump right up into this point A here. And springtime in the long wave cycle, that's the time of healthy growth with low inflation, and we're not going to get that. We're just going to go straight up to the spring into summer, where we're going to have inflation and bonds go down and stocks go nowhere, and the metals shine. And I mean, it's the 70s all over again.
Okay, well, you and I remember that, Chris, but it's really, and the market is set up for that because everyone's more interested in shorting the market, and the most crowded trade on the board's long bonds everywhere.
Yeah.
So, really, it's great to have you here to confirm some of the things that I was saying. It's some interesting work. So basically, bear market in bonds, bull market in gold and silver. And what do you think as far as the dollar is concerned? That's going to also in the 70s.
Well, I think it gets pushed higher here.
Yeah.
But I don't. It doesn't really figure. I guess. The late Ian McAvity, I just always loved his line. Best looking horse in the glue factory.
Oh yeah. Okay. Yeah.
that's the dollar.
Poor Flicka.
Yeah, poor Flicka. That was another just a plot of solar eclipses based on their Saros numbers. So in other words, eclipses at the extremes are just partial ones, and so at the center, and you can see these were important market tops just occurring right on. It's at 1937 and then 1973, and I think part of what the Fed did is really pushed us out, and they bought some time, but the bills are still coming due, and then on the bottom underneath that central line, you can see where the panics and the crashes happen, and it's 36 years, then 58, and then it should be another 36. We should get some kind of panicky thing in the summer 2023.
That is also interesting. How your work lines up with that date. So it looks like the Fed bought us a few years with this action.
Yeah,
keep the party going.
I just think they keep making a deal with the devil, and back in 2000 they said we don't want a recession, and so and so the stakes got raised to a depression in 2008. And in 2008,
Right.
they said, we don't want a depression. And the money printing raised the stakes to credit implosion. And now we've had credit implosion, and they say we don't want to pay the price. And I mean, eventually the price to be paid is societal collapse. And you know, but the Fed is in it for the Fed, and the bankers keep the politicians in power, or the politicians keep the bankers rich, and neither one of them cares about us too much.
You know, that last statement you said, like a lot of people say, well, that's really, oh, you're negative, you're an alarmist. But, you know, if people just look around at what happened in a month's time, this type of event, where if it wasn't for government intervention and giving people some float, which, you know, isn't going to last forever, I still think we're going to have, there's a difference between the stock market railing and what the economy is doing. But people, when you talk about societal collapse, what if there weren't stimulus checks that went out? What if there wasn't money for unemployment insurance? So, you know, you really can see what's happening with the supply chain and meat plants closing and everything that, you know, people like you and, you know, amateurs like me have been talking about this possibility for a long time, that we were, you know, you need to be stabilized, maybe go get some lithium. And, you know, I think that we've witnessed really being on the brink. And I think that people could actually understand how there could be a societal breakdown after
Well, yes,
watching what's happened here.
and just because and the extent of you know, I mean, they're handing out lifelines, and so, but it's just so
Yeah,
obvious that most people who are just been impacted aren't getting the help. You know, the fat cats lined up to the front of the trough and got theirs, but you know, just the devastation in small businesses across this country, and yeah, it's
yeah,
all very scary.
yeah.
I have
But
one more
yeah,
slide.
go ahead, Chris.
Uh, you know, I do some interesting short-term work with tides.
Oh yeah, I went to your website and saw this title stuff.
As well, spiralcalendar.com, which is, you can
Yeah.
see there in the lower left,
Okay.
who are interested in my work. Uh, Now, this tidal sum, this is really just from a point on the East Coast, it's showing you in feet the combined drop from high to low tide of both tides during a day. You know, there are two tides every day,
Right. Right.
almost. So this is a pretty good way to look at the data. Uh, what's fascinating to me about the tidal work is that when markets are emotional, it's very effective. And then when markets are unemotional, just throw this chart out. It has no value at all. This chart was useless in December and January and into February. And then once we made that top, all of a sudden we're just really in sync with the tides and emotionally. And that's still going, right? I mean, 429.56. We're just got that rhythm nicely. So it's pretty fascinating work, and it's good also because whenever the market moves against the tide, to me, that's making a statement about the trend. So you know, in early April, when the tide was dropping from 4.1 down to 4.8 or so, and markets went against the tide and they advanced, that it was important information about the trend, that you know it's stronger than people think. And you know, and right now we're we went down during the most recent down period, but we didn't go down that much, and now we bounced right back up again. So this might give us an early warning if things. I don't know that we can fully keep this going into mid-June all the way to that eclipse, but I think we've got enough momentum and still enough fuel, at least to go a few more weeks.
Chris, I really appreciate thinker and your work is very fascinating to me. And people can follow you on Twitter at SpiralCal. And your website again, Chris, is www.spiralcalendar.com.
Yes.
That's
And
it.
so thank you for having me. This has been very nice.
Yeah, and it's great that you have you were here today. I tell you what, I'll be paying attention to this eclipse and solstice coming up here in June. So
Yes.
thanks for edifying me and the community today and opening people's eyes up to there are things besides candlesticks when it comes to interpreting markets.
Yeah. Yeah. Well, candlesticks are good too, though.
But I enjoyed it, Chris, and
Thank you, Dale. Thank you very much.
like it or not, you're my trading warrior brother.
All right. I like it. I like it. I'll take
All
it.
right, everyone, that's Chris Carolyn, and that's a wrap for our Turnaround Tuesday. Don't just count your pips and eclipses and tidal waves, count your blessings, and we'll see everyone tomorrow. Adios. Thank you again, Chris.
Thanks.